Okay, everybody, good morning and welcome to our workshop today. We are excited to share nuggets about mortgages, and that is the best topic everybody's asking right now. Can I buy a house and all those things? But before we go in, just a little bit about myself. My name is Esther Sunday. I've been in Canada for the past 15 years. I started off as a medical profession and I transitioned into financial industry 8 years ago because I didn't understand anything about money. And one of the things that struck my mind is we are all working every single day, and none of us actually understands how that paycheck really works for us, right? So you go to work, you get paid, and then the money disappears from the other hand. So the objective that we are here to understand is how can we plan our finances so that we can manage our mortgages properly. How can we make sure that we don't leave big debts behind for our loved ones, right? So we need to understand that part of it. Now, if you have heard about me, I really get passionate helping community understand different aspects of financial concept. It's not just about insurance or investment or mortgages or debts or whatever it is. It's a comprehensive package. And if we understand that comprehensive package starts with a foundation, which all of us need to know that income is everything. Income is everything. And when you talk to a mortgage broker or a bank, they're going to be asking you how much income you make, right? You're looking for a car loan, how much income you make. You want to get a student loan or a child benefit or any kind of pension, they were asking about income. The question is, how prepared are we to take care of our income? Is my greatest vision, passion, and mission to help people understand that if we can secure the income, nothing can stop us. We become really unstoppable. So I won't go into details about that, but I will also just help us navigate the mortgage issue because that is the topic of August workshop. We do these workshops every single month and every topic comes up. So our focus today will be narrowed on mortgage. And with us in the room, we are really privileged and humbled to be in this unit here. And those of us who are joining us online, you need to see the energy in the room. So can we show people online that we are in here by just saying yes, right? Yes, right? So we need to let them know that we are yes here to learn from the brokers. We have a lawyer in the room. We have a realtor in the room, and we'll have Manulife join us online, and we'll have some perceptions about Ontario market as well. What is going on over there for those people who are interested in that part of the city? So with us today is a guru. Can you all say we have a guru in the house? No. You're not giving me enough energy. We have a guru in the house. We have what?
We have a guru in the house.
Yes, Tony Martin is going to present to us the dynamics of mortgages all over Canada, but he has a strategy where he will do step by step on how to do it. And you can't be sitting here or online being distracted with anything because you want to make sure that you got it right. Trust me, I got my mortgage in 2014, and after understanding financial concept, I realized that I actually signed for a package that I could have not signed for. Why? Because I was financially literate. You know, after searching for homes, you just want to sign and get the key. So you have to understand the key components. How can I get myself there? And when you're going to get your pre-approval, how do you prepare yourself? How do you plan yourself? How is your finances, right? So Tony has over 30 years of experience. He's the owner of Kelly Williams. He gave us this beautiful space to produce this event in, and he's just gonna speak right now. And please help me welcome the guru in the house, the only the whole province, Tony Maton.
Thank you. Thanks, everybody. Okay, if we can get to the slide, that'll be awesome. So a little bit about ourselves. Myself and my wife Tessie own Keller Williams. We brought Keller Williams here about 5 years ago. I've been a realtor close to 20 years now. And one of the things with Keller Williams that brought us home was we help each other. It's like one big happy family here. We do it all, okay? So we have about, I think, close to 80 realtors working for us. And what we do is we share everything that we teach. We do a lot of training in here. So I'm just going to go over with my buyer's presentation what I do when I sit down with a buyer. One thing too, my wife is the broker here. She does not sell. So we focus, she focuses on the training and running the brokerage, whereas I focus strictly on, of course, selling and helping our realtors as well. Next slide. So a little bit about myself. Again, I've sold over 2,000 properties. I'm the top sales agent in Winnipeg. We have different categories. Gold producer. I was a gold producer here in Winnipeg. KW, I'm like a triple, I don't know. I just don't even, it doesn't matter to me about the awards anymore. My main topic is to help people. Next slide. So a little bit about herself. Like I said, top 20 producer in Canada, Platinum Award, Gold Award winners. Next slide. So what do you want to learn about the home buying process? So what we do is we sit down and we're going to teach you step by step how we do the buying process. Because there's a lot of questions out there. A lot of people out there think, oh, these realtors make a lot of money, they don't do anything. There's a lot of work that we do behind the scenes. Okay, next one. So I'm going to go through these 5 steps right here: fears, realities, 6 simple steps to home ownership, financing, which Esther will talk to, and next steps. Okay, next. So fears and facts. This is something about buying a home. People say, I can't afford a home. Well, until you do the math, you don't know what you can really afford. I always, as an example, what I always say is we have to go get yourself approved. The reason being, it's like going to the grocery store and buying groceries. You don't know how many groceries you can buy unless you have money in your wallet. So there's no use going to look at houses until you get your pre-approval, until you know exactly what you're going to be doing. Also, okay, I should wait until the market gets better. Well, I'll tell you right now, there's never a bad time to buy a home. The other fear that we have too is I don't have money for the down payment. There's a variety of ways of getting your down payment. Esther's going to help you with that. Fear, and I can't afford to buy my dream home. Well, the best way to get closer to buying your dream home is buying your first home, because we all know what happens with renters. Renters, you're just throwing away money. You might as well invest it into your own property. Next slide. Some other fears that we had: I can't afford to buy a home because my credit isn't good. There's always options. I should wait until I'm certain about my domestic future. No, why wait until you're married, partner, or have children? You should just buy a home because it's a great investment. Fear in buying a home seems way too complicated. No one ever tells you that buying a home is easy. And also, I should pay off my student loans and debt before that. Again, student loan debt doesn't prevent you from buying a home. Esther's going to top into that as well. She's going to show you how you can possibly buy a home when you still have more debt. Next slide. So interest rates. Interest rates are really good right now. They're around the 4% mark. You got to remember, a few years ago, they were up to 18, 20%. People are still buying homes. Long term, your equity, of course. Investment grows. You're paying your debt down. You're always going to have, a home is always a great investment. I always tell people, I says a car loan is bad debt. Home is always good debt because it's always going to appreciate. Your cars do not appreciate. Pride of ownership, of course. You got customized. You got tax benefits, wealth building. Then we show you how to get into investment properties. I've got so many clients that end up buying their first home, and they go, hey, you know what? I want to start helping other people out. They'll buy investment properties. We can show you how to do that. Okay, next slide. Here it is. Back a while ago, 9-10%. Now we're down, we're hovering around the 5%. So again, Esther can tell you more about the interest rates nowadays. Next. Purchase a home for $250,000. So this is interesting. This is a pretty interesting stat. So some people go, well, I can't afford. No, you're buying a home for $250,000 over 30 years, $435,000. You're paying $1,200 a month in rent. What do you have here? You have nothing. You own a house. Here you have nothing. I have investment properties myself, and one thing that my father always told me, he said, I love renters because they make me rich. It's true. They make you rich, right? That's all they do. So carry on. So why hold off on buying? Changing jobs, financial, too expensive, short-term ownership. Again, these are things that Esther's going to help you with, and this is why you need to be working with a mortgage broker as well before you even attack a realtor. Next slide. Realties of the market. Today in Winnipeg, your average home price, that's what it is, $427. Interest rates, 4.89. Again, I just pulled some stats that I've been sharing with people. Growth in the area, buyer's market versus a seller's market. It's a seller's market. Why? We don't have any inventory. So sellers are getting multiple offers on their houses. We got no inventory. Next slide. So one of the things, of course, these are the 6 steps you have to do. First of all, find yourself an agent that's going to look after your best needs. Secure your pre-approval, find your home, make an offer, negotiate, get home inspected, negotiate repairs, close, and be a homeowner. Next slide. Step 1, hiring your realtor. We're applying for a job. When you look at a realtor, he's applying for a job. All realtors do not do the same information. I always joke with people that I coach in this area, in our room, is you don't want to hire a 3-up agent. Does anybody know what a 3-up agent is? That's where they put your house up on the market, they put the sign up, then they put their feet up, and then they want to get paid. And there's some people and when you're going in there, this is why it's very, very important when you're hiring a realtor, ask him exactly what he's going to do. We all have a plan of action. We teach our agents on what to do step by step by step by step. And interesting enough, when it's like an acknowledgement, when you hire that agent and the agent said, and you hired him and you think everything's good, all of a sudden you're not finding a house. Well, it's accountability. Have a conversation with the broker of that agent and say, look, they told me that they're going to do this, this, this. Did they do it all? No? Then you fire the agent, right? We didn't, it's the same thing as if you apply for a job, you're supposed to do this, this, this. If you don't do it, you're going to lose your job. Same as us. We'll lose our job. Next slide. So again, make sure your buyer's agent is going to educate you about the market, find out what your wants and needs are, steer you to homes that fit your criteria, coordinate the work of other professionals, negotiate on your behalf, solve any problems that may arise. Like we've been marriage counselors, divorce, like we've been it all. We've done it all, okay? In my career, I've helped a lot of people. And again, we're always there. And the nice thing about it is I think of all my properties, I think there might be, you count on one hand some people that were not happy with my services. So you got to understand that our business is a referral business. And everybody knows what happens if you do a bad job because it flows downhill twice as fast as it flows uphill. And I get so many referrals. In my career now, like 95% of my business now is all referral business from people that I've done business with. And the interesting thing enough, I've got 2 kids, and when my kids used to bring their friends over, I give them my business cards. And my kids used to always bug me. Who's my best clients? All their friends. They're having babies, they're buying houses. Right? So those are all most of my past clients, my new clients. Next. So buyers represented agreements. I've got a list of, like, when I sit down with somebody, I go through all the document process. And there's a lot of information, and I put everything, expectations in writing, of course, commitments to finding the home, confirmed, between us. So the new thing that just happened about a year and a half ago, there's a thing called the service agreement. We sit down and we discuss that. That gives me permission to send you homes on every property, okay, in the area. This was something that was brought forward with the real estate board, and because the private sector was getting totally bombarded with scams and all this kind of stuff. So when you have a service agreement, you're going to be working with a realtor. And the nice thing about working with a realtor, as soon as that house comes up on the market, say for instance 9 o'clock that house gets listed, you're automatically going to get it to your email at 9:01. And they go, well, no, I'm going to freelance. I want to drive around. I think I'm going to get a better deal with the listing agent. How are you going to get a better deal with the listing agent? The listing agent is representing the seller. Now you're into limited joint, and it opens up a whole can of worms on that. So when to hire an agent, of course. So as an example, this is how I kind of work. So of course it's August. We'll say within 3 months you're going to own your house. So you start working with me in August. We put the finances in order, pre-approval, start looking, under contract, take ownership, move into your home. So usually the process takes anywhere to be three to 4 months. Step 2, of course, pre-approval. Esther's going to talk more about that. I just got a few slides in regards to that. Next. So this is what you want to do when you have a mortgage broker. You want to sit there and you want to make sure you secure all this stuff, okay? And again, she'll tap into this stuff, but I sit down and I have this discussion with them all the time. Next slide. Of course, when we choose a lender, we ask for referrals. One thing I always do is I work with a bunch of lenders, and when I always do, hey, it's always good to get a second opinion. And the reason being, it's the same thing when you're getting a quote on your house, on your roof, on your whatever stuff you're getting. You always want to get a second opinion, right? So why not? It's like a doctor. If a doctor says, hey, you know what, you need to get your leg cut off, are you going to get a second opinion? You're just going to go to that doctor and get your leg cut off, right? You want to get a second opinion. So same thing happens all the time here. So interview with one that you feel more comfortable. That's going to bring you value. Again, backed up on the slides, what I was saying was, they bring you value. There's some mortgage brokers are going to say da-da-da-da, and you say, oh, sign on the dotted line. Next thing you don't know what you signed. Bring value. Whenever they bring value, that's who you should be working with, okay? Next. One thing, too, we try sitting down and identify your expenses. So exactly, some people might get a pre-approved for $500,000-$600,000 for an example. They might go, well, I'm thinking about buying a car, or I'm thinking about we're going to have a family, I'm going to get married, whatever it is. Okay, so start identifying your expenses. Find out what you're comfortable with. And I always say this to my clients. I'll say, listen, I don't want to see you max out on your house purchase, because I don't want to be here in a month putting a sold sign or putting a for sale sign up. So let's not do that. Let's make sure that we're allowed to, and know what your expenses are. Okay, go ahead. Mortgages. And again, I'm just briefly going to throw in this, but Esther's going to talk to you more about this, make sure about your down payment and everything else. She's going to dabble into all this kind of stuff. Next slide. Monthly payment, what it all costs. She'll be talking to you all about that. Next slide. But again, this is something I go over with my buyers. From 5 to 20% down. It depends on what you're going to qualify for. And again, how are you going to get these funds? Side jobs, savings, RSPs. Mom and dad are usually there, in-laws or gifts or whatever. Next slide. Maintain a pre-approval. This is one thing that the mortgage broker is going to tell you. Don't go and buy anything. I had a buyer, I think, it had to be 10 years ago. They were looking at houses around $400,000, and she decided she saw a nice, pretty Mercedes in the showroom. She goes and leases a Mercedes. So her $100,000 buying power went down to about $200,000, and she's all upset. And I said, well, I told you that we shouldn't be doing this stuff. So she says, well, the $200,000, the area that I want to be in, I'm not going to be able to afford. So I guess what you're going to do? I said, you either give the Mercedes back, or you wait until you have it paid off. So this is some things that you want to make sure you do. So don't add any extra purchases. Don't change your job. Protect your down payment. Next slide. Find your home. That's our job. So what in the real estate news, you can grab, and what I always do is I give them a copy of this. Inside the real estate news, there's a map. So what you do is you can grab this off the newsstands. This is every Friday. This is on there. When I sit down with my buyer, I have a color copy of this as well. So I don't know if you guys are aware, but in here, I guess I should have had it out here. In here, there's a map that tells you the different areas of the city, and it tells you they're all broken down. Our whole area, our areas are broken down in letters. So you would be looking at certain areas, and then when we sit down, we'd learn the market, and then abbreviations here too. When you get a listing from us, it's going to tell you, if you're looking for a pool or whatever on here, it'll say all the short forms. So this is always in the magazines, and feel free, we have all these up at the front. You guys can grab those. It comes out every Friday. There's a new listing. So who's been looking at houses? So here's the other thing about it that we always have to do. When you're looking at houses, we always want the decision makers to be there. So if mom and dad are going to be on title, or mom and dad are giving you money, bring them to look at the house. I've had so many people, they go, well, my husband's working, the wife is going to look at it, and I said, well, I'm going to tell you one thing, and it's happened to me numerous amount of times. they've had one or the other comes to the house. They love the house. By the time we get the husband back, house is sold. So I've written so many offers on the hood of my car, so many offers, because we like the house, we're buying the house. So be prepared, bring your checkbook, and I always say that too, jokingly, bring your checkbook, because if we're gonna like that house today, we're buying that house today. Because it might not be there tomorrow, okay? So decision makers should all be done. So when people are looking at houses, make sure everybody is available to come and look at houses, or else we reschedule. Next slide. Okay, so we look at homes to compare. Again, so we fill out a list of everything that you want in your home, how many bedrooms and stuff like that. One of our jobs is we're going to show you, you know, what the market states on that too. What I'll do is I'll run a market analysis on the house, and then the question will be: is this going to be forever your house? Is this going to be a house that you're going to move into for a year, 2 years? Okay, well, we're not going to explain to you. Look at the market increases anywhere about 5 to 6% a year. So if you're going to spend $200,000 on this house and you decide to overbid on it to 240, are you going to get your equity back if you're only going to be there a year? We're going to recommend probably not putting in that kind of money. I never ever disclose to anybody, hey, how much money should we put an offer in for? I never tell anybody that. All I do is show you the comparables. You ultimately make that decision. Next slide. So pros and cons. So again, this is something that we go into. And okay, so condos. Some people go, what are the difference between condos and what are the difference between just living in a house? So the pros, of course, lower cost per square foot, no yard maintenance. Sometimes there's a pool, playgrounds, a good community. Cons, you're sharing ownership of space inside the building, homeowner fees, shared maintenance costs, managed by a board of directors, governed by rules and in regards to pets and vehicle and noises. One other thing we'll throw in there is there may be some maintenance charges, and they call them special assessments. So what I always advise to people to do is if you're going to buy a condo, get on the condo corporation, find out exactly what's going on in that condo corp, because who knows, there might be some major stuff that's going to be going on, and they call it special assessments. But we'll get into that if you're looking at condos. Next slide. When you're looking at brand new homes, there's lots of pros, of course. It's new, warranties. You're picking your lot, picking your features. You're locking in a price. Sometimes you get some good deals. The cons are they may be adding pricing to that, because what happened during COVID, there was these special these extra schedules attached because the price of lumber went up. So all of a sudden, your $500,000 house might be $600,000. Future, some neighborhoods, we've had some discussion on some properties were built. He said, hey, we're moving into this area because there's schools. Next thing you know, the city decides, no, we need more land. We're building more houses. So now they moved into this area where you thought there was a school, but there's no school. Nearby amenities, you don't know about anything that's going to be around there. And plus the firm closing date. On the new offer to purchases for brand new homes, they have an open possession date, because again, the weather might cause lack of supply and demand. So your possession date was supposed to be June the 1st. It might end up in November. We don't know. Okay. Next slide. So making an offer and negotiating. So that's our job. So we sit down, we make an offer. So we're looking at price, terms, 6 basic categories address timing of financial considerations. Contingencies is usually it's conditions that we put on the offer. Next slide. One of the things I recommend, if we're not in a multiple offer situation, we'll always inform you of an inspection. Now, you gotta remember, an inspector does not have x-ray vision. He cannot see in the walls. He's gonna tell you preventative maintenance. As an example, he'll be able to tell you what the air conditioner is 15 years old. Life expectancy of an air conditioner could be 25 years, or a furnace, whatever. So be prepared, within X number of years, you're gonna be looking at buying that or fixing that, And roof, the roof conditions and everything else. All he's going to do is advise you down the road of a possibility of some information that you need to know. So one of the things we do is inspections. Now, agents or buyers have asked, okay, what happens if there's 10 offers on the property? Well, we can do these pre-inspections. There's companies that come out and do a pre-inspection. It's a lot less money, and they can look at the basics, your electrical and your plumbing and things like that. So again, I never tell my clients to write no conditions on their offers. We always have a condition. There was one a few years ago where mom and dad were giving the down payment to a girl, And she kept on losing and losing and losing. She goes, you know what? I'm good to go. I'm writing unconditional. I says, no, you're not. So we wrote subject to mom and dad's approval of the house. Just in case she gets cold feet and says, you know what? This isn't for me. I don't want this house, or, you know, because it happens. Buyer's remorse, right? It happens all the time. So now you're locked in. If you end up putting a $10,000 or $20,000 deposit and you don't take possession, you're losing that deposit. And I think in my career, I think I've had 2 people that walked away and they lost their money. Why? Number one was he lost his job. He just couldn't afford the house. Secondly, they just didn't want to close and they lost their deposit. Okay, next slide. Don't sweat the small stuff. So when you see an inspection, you see this. One of the things I always joke about with my buyers is, well, the house is 1929. I'm thinking if we were close to 100 years old, we'd have some cracking, you know? I think we'd be hovering around a little bit if we were over 100, just close to 100 years old. So this is something we try pointing out. And again, I've got people on my redial in regards to foundations and in regards to roof. So if we go into a house that needs a new roof, I'll phone up my roofing guy. I'll say, what does it cost to do a roof on da-da-da? He'll tell me the rough price. So we know we're not coming in. Instead of a $300,000, we're coming in at $290,000 type thing. So we know roughly some costs. Next slide. Close and be a homeowner. Okay, so this is, now we're getting to the final stretch here. So lawyer, Maureen's going to talk briefly about some of this stuff. So when you're meeting the lawyer, she's going to talk to you on how this all works. This is additional cost that you're going to have to do. So of course, closing costs, and Maureen can work on that with you. Inspections will go anywhere from $300 to $1,000 depending on what you want to use. Miscellaneous fees, for instance, if there's a survey or if there's, we also include 95% of the time is a property disclosure. 1 year of homeowners insurance. There's also title insurance. Again, this is something that the lawyer is able to talk to you all about, and this is something that you may decide to choose to buy. We always recommend people to buy the title insurance. Next slide. And this is what you have to do when you go see the lawyer. Of course, when you're sitting down and meeting with a lawyer, she's going to tell you all this stuff. So next slide. Protect your investment, of course, do your routine maintenance. Back to the home inspection, he's going to tell you your eaves, you know, make sure your eaves are away from your house. Make sure this is this, and then like leakage. Make sure you carry, if you have insurance, you keep your insurance on your house. Always keep a file of receipts. So when you go to sell your house, it's much easier for us knowing exactly what you've done to your property, and you know with the year that it's been done, right down to the appliances, right down to new furnace, new air conditioning, etc. Next slide. So getting started. Any questions?
Wow.
I know I talk pretty fast, but that's pretty thorough.
Can we ask any question? Should we just clap for Tony?
Thank you.
Anyone with a question?
For those who have questions, I would request that you
Come to the microphone.
mic so that our online viewers can hear your questions.
So I have a question that
Sure.
my client asked me, and you covered that. So let's find out. I'm gonna
That microphone. She wants you that microphone. Okay.
Okay, so I got this question,
Sure.
Tony, and you did a good job talking about the entire process. Before I ask that question, you just mentioned something that 2 clients walked away and lost
Yep, their deposit.
Their deposit, right? And I just had a client who actually went through that process because they got pre-approved
Yep.
and they were doing pre-construction. I don't know, the house was being
Yep,
built.
yep.
And that's something that I want you to educate us. The little bit process of when I am purchasing a house that has already been built, it's a process that people get to pay money slowly, but by the time the possession date comes, something has happened, somebody has lost a job. Apart from just walking away, is there any way around that? And I know our lawyer here can also address the legality around that.
Yeah.
What is there for the client? Can they kind of appeal that, or is just a done deal?
So when they're purchasing a house to be built,
Okay.
one of the things that's on the offer is subject to lawyer's approval.
Okay.
Okay, so they're going to go through all the details, and when she meets with the client or he meets with the client, they're going to tell him there's a possibility. You know, right now there's a shortage of lumber. We might be delaying possession date.
Okay.
or we might know there might be some of this or some of that. And then she also will do like, and I've talked to Maureen. I use Maureen quite a bit, okay, on this. And one of the things we had a very similar situation where the builder was taking his time,
Okay.
and so he goes, okay, where do I, I'm paying extra money in rent here. So now we're starting litigation again. That's a question for the lawyer to answer. But when the price goes up like that, and then you end up walking away, it's a fine line. I'm not sure because there's a contract, right?
Okay.
And that'll be a really great question for Maureen to answer when she has her little spiel, probably.
Okay. Maureen, do you want to get that? I'm going to put you on spot because you're also going to share a little bit nuggets about the legalities of this. But just pick up on that question.
Okay.
Introduce yourself and pick up on that question. Please and thank you.
Hey, good morning, everybody. Thank you for giving your Saturday mornings to this. I'm Maureen Terra. I'm a lawyer practicing about 20 years. So at one point, I was also a first-time home buyer. I did it while I was in university, so I've been where you are. One of the things I think that makes me a little bit unique is I am very passionate about making sure people understand the contracts that they're signing. You're not going to come into my office and just have a bunch of sign here stickers. So I like to practice a little bit differently. But for that question, with new homes, it's almost universal that they will have built into it, it's subject to lawyer's approval. And a lot of the time that approval is educating you about what's in that contract. Because different builders have different contracts. They're not like the standard used residential where realtors use a prescribed offer. It has the same wording every time. But when the builders, they have a lawyer who drafts those. So we will look for things like a price acceleration clause. So more and more builders have been taking those out because usually the lawyer's review will result in a request to have the price acceleration clause come out. And that's really where the builder says this is an estimate of how much it's going to cost, but it's subject to the price of materials going up. So during COVID, this was huge because of the supply chain issues, the cost of lumber, concrete, everything went up dramatically. So one of the things we look for is that. The other issue can be because possessions, unless you're buying a show home that's already built, your possession date could be 1.5 years away. Life happens, right? You can be moving jobs, losing a job, having a child. Now what you need to buy is different than what it looked like. But also even the mortgage interest rates may change. So if they've gone up as much as they did in the last few years before finally settling down, you may not qualify anymore when it gets close to possession. So usually your interest rate and your qualification has a time frame around it. If it's 1.5 years out, no lender that I'm aware of is going to guarantee your interest rate for 1.5 years out. So, and the government can come in with, stress tests that come in and change your qualification. So most contracts don't allow you the opportunity to assign it to a new buyer because that was a very common method of dealing with that situation is you find somebody else who wants to buy it. Especially now that it's almost built, it's less risky for them. A lot of buyers will have a clause in there now saying that you can't assign it because you had a bunch of people buying specifically spec on speculation that the value would increase. So they're buying it, but they had no intention of moving in, and then they just sell it at a higher value. So builders wanted to get the higher price. If someone's going to pay more, they want it. But if you're really in a crunch, most builders, they don't want to go to court, right? Lawyers don't want to go to court. I don't anyway. My job is to keep my clients out of there. So usually you can have some ability to discuss with the contractor that this isn't a case where you're not closing because you don't want to. It's where you can't. And if you could find another buyer so that the builder's not out any money, you've just got somebody else who will take over your contract. There's ability to negotiate those things because they do understand. And the last risk I'll call out for the new home construction is the bigger the builder, the less negotiation you have on that contract because they've got a lineup of other people who will just buy it. But it's also the less risk that you're going to be making these installment payments, and then in 6 months when they have maybe $250,000 of your money, they're going to go bankrupt. You're not going to have a house and you're not going to have money. So sometimes less negotiating room also means less risk. So the lawyer's approval process with my office is I sit down with the client. It's not really my approval. It's my client's getting a chance to review with the lawyer, what does the contract say, and does this meet your needs, your risk tolerance? So I will never send off a lawyer's approval condition removal. I ask my client, do you want to remove your lawyer's approval condition? So that's all part of the discussion and the review. And I actually have a personal policy. I don't charge my clients if after the review they decide they're not buying. Because I figure they're out there to buy a home. They're going to use me. I'm going to get in their good graces. They'll use me when they do find the right home. So you do need to be somewhat cautious on who you're seeing for the lawyer's approval as well. Are they actually going to meet with you? Are they going to review it, make sure you understand? And what happens if you decide not to buy? Are you now going to be stuck with a bill? So
Wow,
that was really long-winded answer. I'm so sorry.
I have another question coming from our online viewers. Sunday, we have your question here. How do you handle buying a mortgage as investment when out of province?
Oh.
Is this, I don't know who can answer that. Okay.
We'll tag off.
So one thing with our company, we can sell you properties all over the world. Okay, we're affiliated with everybody all over the world. We have Ontario licensed people in our brokerage. So if you decide to buy in Ontario, we can do that. So one of the things we always tell the person to do, and I've got clients from Ontario that come to Winnipeg to buy all the time, and it's vice versa. So what we do is we'll put the agent in charge of that province. If not, we'll refer it to the agent. Now, if you, for instance, the question, if he or she was coming to Winnipeg, but they're qualified in Ontario, is that what I'm understanding?
Yes,
as an
out of
example?
province, yeah.
Okay, so out of province. So what'll happen is we'd find out, okay, so if whoever they're with, we tag them off with one of our mortgage people here. Because the mortgage people in Winnipeg know the market in Winnipeg. Mortgage people in Ontario know the market in Ontario. And we laugh about this all the time because I bought a house in Ontario and your financing condition can be 3 weeks. I go, 3 weeks? We're taking possession in 3 weeks. Our financing conditions here are usually 2 to 4 days or up to a
Okay.
week tops. So we got to educate the buyer as well. So when they're out of province, we always put that into consideration. Deal with a mortgage broker in Winnipeg if you're buying in Winnipeg because they
Okay.
know the rules.
Okay. Does that answer your question, Sunday? Let us know. And for everyone in the room, if you have any more questions.
Yeah, that's awesome that way. One thing, yeah, that was one thing I wanted to bring up too is you can buy a house anywhere, anywhere. We had somebody come into our office that had land in Jamaica. Wanted to sell land in Jamaica. We're affiliated with people in Jamaica. I said, I need your titles, I need your credentials on the land and everything else to show it's yours. And we fired it off to an agent in Jamaica. They sold the property. So we're all over the world.
Can I just ask my question here? Or do I
Sure.
jump away? So my question is for you. Being that it's a seller's market, how
Yeah.
do the realtors in your office find business right now with the inventory being as low as you mentioned?
Well, we teach, and I'm talking at a school here, we teach our agents to go knocking on doors. We teach our agents on just probably doing some marketing in different areas. That's the way we got to find houses. When my wife was selling, I'm dating herself now here. This had to be 10 years ago. She had a buyer that lost a house. He wanted to be in this specific area. Mom and dad were here, babysitter was here. She lost the house in multiple offers. So she says, well, that's fine. And she went and door knocked every house in that area. They said, if I have a buyer right now for your house, would you sell it? She goes, yeah. Okay, do you mind if I bring my buyers in to have a look? Yeah. Sold the house. See, again, that's an agent that's going to do that. Some agents go, I don't know, talk to somebody, go to an open house or whatever. We take the initiative all the time, and we'll do that. One other thing, having one of the biggest brokerages, we have our own group chat, so we could send out a group and say, hey, I have a client looking for a rental, or I have a client looking for a 3-bedroom house in Southdale, or I have a 3-bedroom house in Niverville or on Pembina. We share, and that's something that we do as a big family here. And we always, you'll hear me say that all the time. We're a big family here. We share all our stuff here. Like if somebody goes to us and says, "Hey, how's your listing presentation?" They'll plug and play. This is all. It's all as a draft. You put your own stuff in there. The same thing happens when we're showing people houses. You know, they'll take. We'll go and show them this stuff, and we have certain criteria that you do when you're showing houses.
Any other question? Yes.
Hi.
Please on the question.
For sure. Hi, my name is Tamar, and I would like to ask this question. I've been kind of seeing online on just people buying properties through an RRSP
Yeah.
loan.
Yeah.
Would you think that would be an appropriate way to, let's say, buy pre-construction?
Well, depending on again, that's a question for your mortgage people, because you got to find out who you're borrowing money, like the RSPs. Because I can lend you my RSP money, you can lend me yours, but you can't use individual. If you're using that as a down payment, that's up to the mortgage broker to tell you how you can pull that funds out. First-time home buyers. I know when my son had money in his RSPs, he was able to borrow on those RSPs for his down payment for a personal house. Now, are you talking personal or are you talking investment? You know, these are questions too, right?
Okay, so we have a broker in the house. I
Another
think
broker in the house.
Dennis can answer
Sure.
that question. Could you please come on?
Sure, there you go.
Thank you, Dennis.
Where should I stand, right here?
Anyway, here, there, it doesn't
Yeah, I can stand right
matter.
here. Yeah. Is this okay?
So how would you handle that with an RSP?
So I guess there's two ways tomorrow. Are you thinking of taking an RSP loan to load up your RSP since you have contribution room and then take it out after 90 days as down payment? Is that what you're thinking? Yeah, so it can be done. The only thing you have to remember is this. You now have to make 1/15 of whatever you took out every year back to the RSP that you'll have taken out for down payment. Plus you have to make payments to the RSP loan that you took out. Plus you have to make mortgage payments, property tax, and all that stuff. So it's a balance between how much income are you bringing in and can that income sustain the purchase price that you're looking at with the down payment that you'll have taken from the RSP, that came from the RSP loan, and can you make payments to the RSP loan, and can you put back 1/15 of what you took out, because you've got 15 years to put back into your RSP. So you have to juggle all those things. Yeah, it's been done. I've done it, and you can just meet me on the side. I'll show you how. Okay.
Thank you very much, Dennis.
Now, with that being said, in terms of financing and everything, planning your finances, which strategy to use, you can book a one-on-one appointment, right? So that's why we have expertise. We have Tony here, we have Maureen here, bringing the legal aspect of it. Dennis is there, he's a mortgage broker, and everybody. That's why we are sharing expertise, right? So you can learn from that, right? And in terms of planning the finances in preparation, I deal with that. So I will advise you on how we can do it together and prepare for them to lead you into a great home so that you're not struggling when you're in that home, right? So I think that makes more sense. Do you have any other questions
Any
for
other
Tony?
questions for me?
You have something for
I have a lot of questions for him, but I'll
You
find
can
it this time.
one time, right? So before we let Tony go, so I'll let Maureen stand next to Tony, right? Because it's the same group. And I will let Liz join them because Tony is
Yeah.
coaching Liz in this career. So the three of them belong to one office. You have a realtor there, you have legal aspect of there, and then she'll probably be the one knocking at the door asking, are you going to sell your house? And bringing in Tony, I found a house to add on the inventory, right? So this is a great way of having that communication started. And the way they say they do their things, they don't push things on people, right? So they have that aspect of giving you. They don't want to list a house and put the legs up. How did you describe that?
The 3 up people.
3 up, right? You don't want to have an agent who has listed your house and the legs are up and waiting for you to pay. Because again, it's about your money and it's about a great service. You don't want to go to the house and find foundation issues because they didn't talk to you about the inspection, right? Or you oversee that. Or you don't want to lose money because you didn't want to put a condition. You didn't listen. They will not tell you to put or not. She says clearly, she asks the client. She educates the client, and then the client will make that decision. Our main objection is all education, education, education. So thank you so very much for the powerful presentation. Can you clap for them, please? Thank you, thank you, thank you, thank you. So we'll have all their contact information at the reception. You can book one-on-one meeting with them so that you can get your questions answered. And Dennis, I will need you at some point, but for now, we are going to go into another. Sorry?
The online viewers.
Okay. Did everybody learn something today? Yes, I did. Did you hear someone who lost the job and lost their house? Who had that? Did you hear me talk about protecting income? Yes. Right? So you understand how important an income protection is, right? So we need to make sure that we have a disability plan in place, critical illness plan in place, and in case of a death, that property is taken care of because somebody gonna pay it. Is it your wife? Is it your husband? Is it your child? Do you want to leave debts behind? Nobody wants to do that. Do you want the biggest estate inherited to be the government because you just failed on estate planning? You don't want that. So that's why we want to make sure that we get proper knowledge, proper education to put this package together, right? You can't pull one out of the puzzle. You need a lawyer to understand legality. You need a real estate agent to give you what you're looking for. You need a broker to help you look for the right services that you want, right? So our next package is going to go into lending. Lending is a big topic. Lending is becoming an issue, especially after COVID hit and everybody realized they want to work from home. Everybody all of a sudden wanted a house. And then we had to have some changes in the way that is being done to benefit the customers, people, so that people are not bidding for houses too much. I have somebody who bid $150,000 on the listed price in 2022 just to get into that home. And Tony explained, when you do that, how long will it take you to first get to that point and then start accruing the equity in the house? Because you are rushing through something or you are emotionally driven with something and you didn't think through and you made the wrong decision. So that's why we're here to educate us. Now, our next speaker is going to be talking about one product that can take care of everything. Have you ever heard about banking in one institution, having the mortgage in the same institution, line of credit in the same institution, credit card, and running your line of credit on your home in the same package? Some of us got declined by basic line of banks, right? So you go to a broker, maybe you are in a credit union and you're banking with Scotiabank or CIBC. Now your banking salary goes here, your mortgage is there, and you have some Walmart or TD or Canadian Tire credit card, and it's all over the place. It's like you're doing like this, your head, what am I supposed to do with this? So our next speaker, Blair, is going to talk about Manulife One. Manulife One is a very unique strategy, and we have partnered with them. They're actually one of the insurance companies that we work together with, and we have all services in place, right? So Blair is very expertise in this. Blair has a lot of expertise.
Sorry, I'm gonna mute Blair for now.
Oh, Blair is ready to go, right? So Blair, apart from working with Manulife, he's worked in different financial institutions. He has a financial a financial license as well. And he's going to join us online. He couldn't be here in person, but I just want him to unveil what Manulife has put in place together for us. Are we still having a party in the house? So, are we ready? Blair? Are we ready to go?
Hold on, we're gonna transfer him.
Ready to go on my end. You hear me?
Yes, we can hear you loud and clear.
Perfect. Thanks so much for the warm introduction. Sorry I couldn't make it in today. I'm out in Morden, Manitoba for the Corn and Apple Festival. So you have the parade going on right now, and I'm logging in virtually. So thanks very much for having me, and thanks very much for taking the time on your busy day to join us. So for the next 25 minutes or so, I'm going to go through our unique mortgage and banking product. It has the potential really to save you thousands of dollars in interest and make everyday banking and cash flow management much less stressful. So after the presentation, we'll open things up for a quick question and answer period, but we also encourage you to connect with Esther at a future date regarding some of the strategies you've heard today, and she will help position those and make the referral process off to Manulife Bank. Next slide, please. So let me start by telling you about Manulife and Manulife Bank. So our parent company, Manulife, has very deep roots here in Canada. It was established 130 years ago by our then Prime Minister, John A. Macdonald. So at that time, there was no non-compete clauses or conflict of interest clauses, I guess. So you could be a prime minister and at the same time run an insurance company. So Manulife is one of the largest life insurance companies in the world, and that's really what most people know us for. Life insurance, group benefits, and investments. But a lot of people don't know that Manulife also has a bank. So in fact, we're a Schedule 1 domestic bank, which is the same category as the largest banks in Canada. And the bank piece, even though the Manulife parent company was established 130 years ago, Manulife Bank was established in 1993. Next slide. So Manulife One, or the M1 as we call it, it's not just a mortgage product. So I want you to think of Manulife One as a cash flow management solution. So think of Manulife One as the foundation of your health. It's important to have a strong, stable foundation. That foundation allows you to build an addition and all other aspects of the house. So think of your cash flow as the building blocks of that foundation. Without the right cash flow, you cannot fund your day-to-day needs, proper insurance coverages, children's education, or fund your goals in retirement. It all comes down to your cash flow or your foundation. So what if there's a way to optimize cash flow without changing your income? That's what we're going to talk about today. You work hard for your money, and you want your money to work more efficiently for you. Next slide, please. So if you're like many Canadians, you constantly got money coming in and money going out. But what if you could deposit all your income and put it to work, reducing all of your debt? Not only would it be easier for you, but you could pay a lot less interest. That's what Manulife One could do for you. Manulife One combines your banking, mortgage, and line of credit into one account with a low variable interest rate that's calculated daily. You also have the flexibility to pay off as much as you want, whenever you want, or to adjust what you pay as your needs change. Plus, you have the convenient access to the equity in your home up to your borrowing limit. It gets even better. Manulife One is also a bank account. But unlike other bank accounts, Manulife One actually helps lower your debt. Every dollar you deposit reduces the balance on what you owe. Since interest is calculated daily, you pay less interest for that month than you would with a traditional mortgage. Your money is still there, ready for you to use when you need it, but until you need that money, it's working, reducing the interest you pay. So if you also like the structure of a regular mortgage, with the Manulife One, you can tailor your mortgage with fixed rate sub-accounts. So these fixed rate sub-accounts allow you to lock in a portion of your mortgage with fixed payments. It's a great feature if you think rates are going up or you simply want a fixed payment amount. So having the M1 is like being your own banker. It's the best of all worlds in one account. Next slide, please. So a lot of your finances look something like this. You have your income coming in to your checking account. From there, you're moving excess savings to and from your savings accounts. Money's also being sent to pay your bills, mortgages, credit cards, lines of credit, car loans, and other loans. So this is a traditional approach to money management. And having debt in separate accounts may be what you're used to and comfortable with, but it's a comfort that is expensive, time-consuming, and very stressful to manage. Just looking at this chart above, would probably make a lot of people anxious just looking at it. So unfortunately, you usually receive little or no interest on the money you deposit into your checking account. This is the same money that the bank turns around and lends back to you in the form of a mortgage, car loan, credit card debt, lines of credit, or other loans, charging a very high rate of interest. But there is another way, and that's called the Manulife One. Next slide, please. So Manulife wants to show clients how they can get their own money to work for them and not just the bank. So the first thing that we would do is secure a line of credit against your home, which any bank could do through a home equity line of credit. But we also consolidate the savings account balance and the debt, whether it be a line of credit, debt, line of credit, credit card debt, mortgages, into the new line of credit. So now your savings are working for you against the debt, saving interest. Then we're going to do something completely different, something that none of the major banks want to do for you. We are going to let you use the line of credit as a fully functioning checking account. So every time you get paid, every time you deposit money into this account now, that money is going to go directly against the principal owing on your debt or mortgage. Because interest on a line of credit is calculated daily on the closing balance, you owe less money that day, you pay less interest that day. Next slide, please. So now let's talk about how the M1 compares to a traditional mortgage. Compounding interest is great for your investments, but not for your mortgage debt. So the first thing that you will notice is that the interest on a traditional mortgage is heavily front-loaded. With amortizing debt, you are paying predominantly interest payments in the first 7 to 10 years. So think of your annual mortgage statement. For example, you open that up and see $18,000 paid to your mortgage each year. But then you see 13,000 of that went to interest, while only 5,000 went to pay down the principal. That can be very demoralizing when you're trying to get ahead. So with the Manulife One, it's simple interest on a daily basis. We calculate interest based on the closing balance of an account each and every single day. So the second thing you'll notice is the banks limit your principal paydown. This is usually limited to a double up option each month or prepayment privileges of 15 to 20% of the principal amount each year. So how many of you currently take advantage of your prepayment privileges in this room? I bet it's not many. With most Canadians, they don't make these payments because of cash flow concerns. So as soon as you give your money to the lender in form of a prepayment, you can't take it back in a week or two or next year in case of emergency comes up, if you need car repairs or to fix a furnace, etc. So you lose availability of that equity by making a good financial decision to pay down your debt faster. At Manulife Bank, we don't believe that it's right to penalize you for making strong financial decisions. So instead of paying down mortgage debt, most people would rather keep their money liquid in a checkings or savings account for emergencies. The problem is these accounts are not paying you any interest or very little. And when taking inflation into consideration, you're actually losing purchasing power by holding on to your money in these accounts. So with the Manulife One, there will be no limitation to principal paydown. That is why our clients are putting all of their money, including their entire paycheck, into the Manulife One account. If an emergency pops up the next day, the funds are available for them to take back and use the equity that they've built up in their house for these emergencies. So the last thing you'll notice with a traditional mortgage is that when you make a payment, immediately part goes towards interest and part goes towards principal. Not all your money is going to pay down principal. So with the Manulife One, you make a payment, every single penny will go against principal first, and the interest will get added on the last day of the month. So your money will be working all month long without the cost of interest. So these three things make us completely different from a traditional mortgage. Next slide, please. So, and if you really think about it, there are only two ways that you can pay down a mortgage faster. The first way is frequency of payment. So with a traditional mortgage, most people pay it biweekly because it corresponds with their pay structure. That's a great idea. It helps pay down a mortgage marginally faster than if you were to do it monthly. You might save a year or two doing it that way. And the second way is the lump sum payment or prepayment privilege, which we already touched on. So if these two things are the only way to pay down debt faster, imagine how the Manulife One works. You're accelerating the frequency of payments from biweekly to daily. Every single day that your money sits in the Manulife One account, it's knocking down principal and thus saving interest. And in terms of extra money or prepayment privileges, you can't put any more than your entire paycheck against your mortgage. So we're really maximizing it when it comes to that aspect. Next slide, please. So every month you'll receive a statement from Manulife Bank with the Manulife One. It's really the most comprehensive bank statement that you can get from any bank. Our statement also acts as a budgeting tool, allowing you to track not only how fast you're paying down your debt, but where your money is actually going. And so at Manulife Bank, we believe that feedback is a huge motivator. When you can see how well you're doing with your finances and you check in regularly, we believe that allows you to be a lot more responsible. So when you can see how you're doing every day, it will help you get to your financial goals a lot faster. And the next series of slides, we're going to go from top to bottom through the full Manulife One statement you'll receive on a monthly basis. Next slide. So this is the top of the kind of the first section of the mortgage statement. So it shows how much you owe the first row at the beginning of the month. So in this case, it's just over $155,000. The next line is your income that went in that month. So roughly $5,100 in this example. So remember, this is now your fully functioning checking account. So as soon as the income went into the account, it immediately brought your debt down from roughly $155,000 to $150,000. Now you are only paying interest on that $150,000. It doesn't work like that with a traditional mortgage. But if you have to spend some of that money, of course, and that is what's shown in the third and fourth lines. This client spent roughly $4,000 in expenses, resulting in debt at the end of the month of $154,146, a reduction in total debt owing of $1,122. The interest charge of $710 on the next line was included in the $3,967 expense line in line 3. So that's all been accounted for. So that reduction in debt owing of $1,122 in a month is massive. We wouldn't be able to pay it down that fast with the traditional mortgage with the limitations. But seeing here, it was only based on a monthly income of $5,000, which is in line with Manitoba averages and expenses of $4,000. So this person in this example, they're not millionaires. They're just average income earners, average spenders, and they're paying this off very, very aggressively. $1,122 per month will get your mortgage down extremely fast. So remember, there's no mortgage payments or line of credit or credit payments or car loan payments now. Everything has been consolidated into this Manulife One. There are just your household expenses. So that's really what the program is. It's a function of income and expenses. And if you can keep that gap nice and big, I promise you, you will be paying down your debt very aggressively. And as I said, it doesn't work for families making a boatload of money every month. It really works for the very average income earner who's responsible with their money. So the bottom line show your limit. So we set the limit at 80% of the value of your home. If you'd like to go up to that point, of course. So the Bank of Canada only allows homeowners to go up to 65% of the value of your home on the main line of credit revolving piece. With that being said, if you would like your limit to be greater than that 65% of the value of your home, we would need to lock in the remaining 15% into a traditional amortizing mortgage. So our program has a sub-account feature to enable this, which I'll explain later on in the presentation. Next slide, please.
Hi, Blair. Just hold on that slide for a little bit. I just want to emphasize something on that slide because I think that is our biggest deal here. So for those who are in the room, and you can see actually what Blair is saying, and this is what Manulife One stands out uniquely, the idea of having your paycheck roll into one account is what we are emphasizing because everybody makes a paycheck. But before it goes to your lines of credits and pay car loan and all that stuff, we want to put it in one basket, and that basket automatically reduces your mortgage. In this case, $155,000, you get paid $5,100, your mortgage automatically reduces to $150,000 before you do anything else. Now you can use that to revolve and pay other things. But this kind of setup needs a lot of discipline because you will be seeing $240,000 in your account. Like you think you have money, but you really have to understand financial concept. How do you do this? You don't see the money and say, okay, I'm going to buy a car. It's a way of helping you run your finances in one place. And that's what Blair is trying to bring up here. So thank you so much. If you can take a screenshot of that slide, that's how you can talk to us one-on-one and help you plan accordingly if you're a best fit. Remember, you have to also qualify for what Blair is talking about. Keep up. Thank you.
Yes, thanks very much for jumping in there, Esther. That's a great point to make. Even though, like I said, to take full advantage of this account, you don't need to be a millionaire by any stretch of the imagination. But you do need to be a good budgeter. You do need to be responsible because there is a lot of freedom with this account. So for clients that think that now they have all this equity in room and they're going to make a lifestyle increase and they're going to go to Vegas a couple times a year and buy a boat and really use this line of credit to increase their lifestyle, this product is not for you. This is for a responsible budgeter that is interested in paying down their debt aggressively. And it's very important for people with this account to constantly do check-ins, right? You want to follow out, okay, if I had a traditional mortgage right now, how fast, where would I be versus the Manulife one? How am I doing better or worse? So you really want to be a good budgeter. You want to stay on top of this thing and do periodic check-ins to make sure you are using this account the way that we intended to, and that's paying it down faster. The big banks will never say that. The big banks will always say, we don't want you to pay down your mortgage as fast as possible, because the longer the mortgage is outstanding and the higher the volume, the more interest the bank is earning from you. At Manulife Bank, we want to see you pay down this debt aggressively and be in a great financial position by the end of it, by paying off this mortgage extremely quick, at the same time allowing you to make your annual contributions to investments and insurance with Esther. So we'll go to the next slide then. So this is just the graph at the bottom of the page. Just shows you how you're doing year over year. So like I said, a comparison. So as you put money in, the graph goes down. As you take money out, the graph goes up. But what's unique here is it's basically, if you're kind of taking the main points, it is a very straight line that the graph goes, from the top left to the bottom right. Traditional mortgage, it's more of, like I said, it takes the first half. You're paying a lot of interest, so it's really flat, and then it'll start coming down towards the end. But you're going to be very flat for the first half of the mortgage. Next slide, please. So if we turn the page, this looks like your checking and savings account. So it's very detailed with all your income and expenses. The only difference here that is becomes a bit of a shock. I'm sorry, my dog is barking in the background. So it's a negative number because it is debt owing. So in this case, the main account was, I believe it's $96,000. So that's a negative number. That's how much you owe to Manulife Bank. So you're seeing it now go from 96 and paying it down. So it might take a little bit of getting used to see your checking and savings account statement like this in the red. So if we take a look at the next area, sorry, next slide, please. So this is the top of page 3. That's the fixed rate sub account. So the page before was the main line of credit piece, and this is the fixed rate sub account that I briefly touched on earlier. So think of these sub accounts as a mini traditional mortgage within the overall M1. So the main account operates as a revolving line of credit, giving you that flexibility, but then you can set up these fixed rate sub accounts that operate as a traditional mortgage. So these rates are locked into a specific term with specific interest rates that are very competitive with the leading mortgage companies out there. So the payments will be made automatically from the main account on the last day of the month. So again, you don't have to worry about transferring payments or managing 2 separate accounts. Our goal here is to simplify things and make it all in one account. So that money is taken out from the main account to the fixed rate sub accounts automatically. So it's all in one now, and you can lock in up to 5 different sub accounts. So if you want to lock in some of these now, when you set up the Manulife one, you can do so. And you can also call into our customer service line, say a year from now, and lock in another piece. So it's great if you think, okay, rates are just going to start coming up. I want to lock in a larger piece. I'm going to phone in and do that. So really the main selling feature of this account is flexibility. You really are your own banker. So here's something that we're really interested in the middle of page 3, something very exclusive to the Manulife One. So these are called variable rate subaccounts. So these help you track debt separately. So if at any time you invest money and you want to track the interest portion separately because you need to keep an untainted account, we can do that for you with these variable rate subaccounts. So think if you lend a family member some money and you want to teach them responsibility by paying you back with interest. So it'll show and track how much interest is accrued each month on that specific portion. So you can open up to 15 different sub accounts, and you can actually name them whatever you want. So another great use for these variable rate sub accounts is to use them for investing purposes, as opposed to something like an RSP loan. So when you set up a sub account for this purpose, you can now easily see the interest paid, which is also tax deductible. So easy eyesight, easy tracking, and you can write off the interest exclusively from that sub account. So this really is the most comprehensive bank statement you can get from any bank. Next slide, please. So on the 4th page, so I've already broken down your expenses into categories: debt cards, bill payments, cash withdrawals, and checks. So you'll see that there is one unlimited daily banking fee, in this case $16.95 a month or $9.95 for senior citizens. So that covers you and everything on the account for everything: unlimited debit card use, unlimited internet banking and telephone banking, bill payments, and check writing. So a lot of clients at this time will tell me, I don't pay any fees at my current bank. But the truth is you are. If you have money sitting in your checking account and doing nothing, not earning you interest, that money is costing you interest because it could be working to pay down your debt and putting it against your debt as an after-tax savings in our case. Sorry, just go to the next slide, please. And so what I mean by this is that you put the same checking account money into a GIC or high interest savings account, you will earn interest. Therefore, you will have to pay taxes on the gain. If you take that same money and dump it into your Manulife One, not only is it saving you money immediately because there's no tax implication. So for example, 3.2% after tax in a typical Canadian tax bracket is like 5.5% investment in the market after taxes. So there's no guaranteed investment in the market today that will pay you that type of return. So this is not only an interest efficient account, but it's also a tax effective account. When taking these savings factors into consideration, the administration fee starts to feel very negligible. So another great product that we offer at Manulife is our Visa card. All clients approved for a Manulife One are also approved for a Visa card. While signing up for the card is not mandatory, if you do accept the card, the M1 administration fee is waived for the first year. And if you spend $20,000 annually, your Manulife One administration fee will continue to be waived in subsequent years. Next slide, please. So now that we have a pretty good understanding of how the Manulife One works, I'm going to go through our online calculator where we can put real world finances to see how you can save using the M1 versus a traditional mortgage. Next slide, please. So this is what our calculator looks like. And generally it'll be the mortgage specialist. So if you want to move forward with an application, you'll meet with one of our mortgage specialists. And what they're going to do is go through this calculator with you, and you're going to input your specific finances into this calculator. For the purpose of this presentation, I've used Manitoban averages thereabouts, just to give you a good illustration. But like I said, you'll go through this using your specific information. This calculator is also available online, but it can be a little tricky to use. So I very much encourage you to reach out to Esther if you are interested in our product, and she can align you with one of our mortgage specialists who will go through this with you. So the top row here, what is our current value of your home? I've inserted 400,000. That's roughly, Manitoba average. And current mortgage on the debt, I put in 244,000. Again, rough averages. We're not talking about $1 million homes. I want to make this applicable to most people. So current interest rate, right now, the 5-year interest rate in the market in and around 4.79%. And that's 5-year term. You're locking in for a little bit longer. and that's the lowest, lowest interest rate on a term you can get right now is for 5 years. So inputting that and assuming a roughly 24, 25-year amortization, it makes our monthly payments $1,420. So I use a separate calculator to figure out that $1,420. Next slide, please. So then the second page of the calculator is where we're going to put into our savings. So as I talked about, your checking and savings account, you have to keep money in there using a traditional way of banking because you need that money to fall back on. You need it to pay your bills. You need it for emergency funds, all sorts of things. So in your checking account, I put in, you have $5,000 in this checking account to cover all your bills, expenses, a little bit of a buffer there for your credit card payments at the end of the month. Savings account balance, $8,000. Other short-term liquid savings, $7,000. So again, you're going to put in what you specifically have in your accounts for this, but those are the numbers that I've used, trying to keep it industry averages. Next slide, please. And so the next slide here is going toward a summary of your debt. So this is where, if you have the ability to consolidate some of your debt, whether it's car loans, if you have credit card payments outstanding, other lines of credit, other personal loans, and want to consolidate into the Manulife One, you can do so here. For the purpose of the presentation, I haven't included any debt consolidation. If I did, the Manulife One results would come out even stronger, so keep that in mind. If you do this, because chances are, if you have a car loan, it's much higher rate than what we're able to provide because it's not secured, where the Manulife One is secured against your home. So our rates are a lot lower. So again, if you were to consolidate debt, the Manulife One would be even more attractive. Next slide, please. So here's where we put cash flow. So top row here, again, using the industry averages or Manitoban averages, monthly household income after taxes, $6,500 for your household. And then mortgage payments, $1,420. We already calculated that from slide 1, so that was auto-populated in here. And then other monthly household expenses, not including your mortgage payment. So I put $4,000 in here. Again, you can see I'm not using a household that's a millionaire. I'm using industry averages. So they're not, have a massive buffer between income and expenses. They're doing well, but nothing outstanding. Next slide, please. So this is the last page of the calculator. So this is the summary. So we say our Manulife number. We refer to the Manulife One number. That number, believe it or not, using all of the variables that I inputted, is how much you would be saving using the Manulife One versus a traditional mortgage at 4.79% for the next amortized schedule over 25 years. You would save $67,529 over the next 24, 25 years or so. So a huge, huge number. And again, you're going to go through this. Everyone's going to have a different Manulife One number. But again, I've tried to be very conservative here and show you what most Manitobans could save if they're responsible and good budgeters. When you go through this calculator, I really want to encourage you to not get too aggressive. Like I said, we don't want to put this product in the hands of someone that's going to drastically increase their lifestyle, go off to Vegas a couple times a year. But we still want you to live, right? We want you to budget for vacation. We want you to budget for life insurance. We want you to budget for your investments. And, that's where Esther comes in and can help you out. But include these things in your budget so you still have room to live. But like I said, with those things considered, what we find is the majority of good budgeters, good savers will come out with the Manulife One number similar to this, $67,500. So the Manulife One, it's a variable interest rate. So for the main line of credit, like I said, the fixed rate sub accounts, those are around, we have the 4.79 for 5 years. We have a 4.99 for 3 years. So those are the fixed rate sub accounts. But the main operating line of credit, the readvanceable piece, that is prime plus a half. Right now, the Bank of Canada, with their rate announcements, which is what dictates banking prime, we're at 6.7%. So it's 7.2%. So it is a bit of sticker shock. 7.2% is much higher than 4.79%. But I've just showed you how you can use 7.2% to come out $67,000 better than 4.79%. So the caveat with that, even though I've been super conservative, even though this account at 7.2% is way better than 4.79%, it gets even better because the economists right now believe that interest rates are going to keep coming down. So they've already come down 0.5%. So we were actually at 7.7% 4 months ago. That account now is variable. So it's always coming down, fluctuating, going up or down with Bank of Canada's rate announcements. So 7.2%. The major economists right now, 5 out of the 6 major economists, think that prime will actually go down from 6.7% to around 5.2% at the end of next year. You'll take advantage of those interest rates reductions. And again, that's crystal ball thinking. That's their predictions. It doesn't necessarily mean it's going to become true. So don't turn around in a year from now if interest rates haven't come down and told me I lied. It comes with the caveat that the economists are not always correct, but that is what their predictions are. So it's crystal ball thinking, but that's what they believe. So if what they believe holds true, the Manulife One account will be lowered from 7.2% today to 5.7%. Vice versa, I showed you a 4.79%, and that's what we were comparing it to. That number is locked in for 5 years. And again, so that's $67,529. $67,529 will only get better if Bank of Canada keeps decreasing their rate. That number is only going to get higher, and we haven't taken that into consideration. So yeah, I would encourage you to, if you are interested, reach out to Esther. She can align you with the mortgage specialist who can walk you through the Manulife One calculator and find out what your Manulife One number is. Next slide, please. So by putting a Manulife One in place today, it really becomes your account for life. Even after the account is paid off, if your roof leaks, markets drop, or a great investment property comes on the market, you don't need to go to the bank now. You have access to all the equity in your home that you work so hard to pay off. You can write a check directly out of your Manulife One that very same day. So you essentially become your own banker. Additionally, if you use those funds for investment purposes, you are able to write off the interest paid for tax purposes. Also, a little known thing about the Manulife One is that it comes with a measure of insurance against mortgage fraud. So even if you are debt-free, with the Manulife One registered on the title of your house, identity thieves won't be able to take out a mortgage or loan on your house without us knowing about it before it happens. We would then contact you to ensure that you are looking to do this, and if not, we'll deny the request. Next slide, please. So if you're looking to refinance from your existing mortgage lender, Manulife Bank will actually cover the cost of title registration and appraisal. There's no application fee either. So essentially no cost for you to move your mortgage from your account, from your current lender to Manulife at maturity. For the application process, we have a team of mortgage specialists available that can explain and go through the application process with you at no cost or commitment by you. So the mortgage specialist will take the time to go through the M1 calculator, which again can also be found on our website, and they'll also be able to answer any detailed questions that you have. So yeah, I'm really glad we have the opportunity to show you how the Manulife One will streamline your banking and hopefully save you time and a lot of interest costs. So I threw a lot of information at you today. Again, it's a whole new way of banking. It's likely not the way that your banked and your grandparents banked, but it really is an amazing tool for those that use it correctly. So if you're interested or any questions on the Manulife One product and you think it might be a good fit, please get in contact with Esther and she can help you direct you to one of our mortgage specialists. Thanks very much for taking the time today out of your busy schedules, and hopefully you found it informative.
For Blair, he did a great job. Thank you
You
so
too.
much, Blair. That was awesome presentation. Do we have any questions in the room to begin with? Any questions? Yes, Dennis. Yeah.
Thank you, Blair. Very good presentation. Can I hold a Manulife One account under a corporation, assuming the corporation owns the primary residence?
You cannot. No, it has to be a primary residence owned personally.
Second question, is the Manulife One ideal for clients who spend less than what they make, and then the difference ends up being savings that ends up in a Manulife One account to earn interest?
Sorry, can you repeat the question, please?
Is the Manulife One account ideal for clients who spend less than what they make, and then the difference between that is savings that ends up in the account to earn interest?
Exactly. That's
Eventually, once
really
they
where
figure out-
that $67,000 that I'm the Manulife One number that we went over. That's really what it comes down to. That gap between your income and expenses, and having that buffer there. All that money is working every single day to knock down that principal balance, and that is really how a rate of 7.2% on an account like this is better than and spends and is less costly, I should say, than a 4.79%, if you can believe it or not.
And the difference between the 4.79 and the 7.2 is really because of compounding and like the simple versus
Correct.
the other interest, yeah?
Correct. Yeah. So traditional mortgage, you are really paying interest on top of interest, right? And then it resets once your payments are made. With the line of credit feature, it's simple interest calculated daily. So as soon as you get paid on Friday, now that balance has come down on the Saturday morning, and that's your new balance. That's your new principal that you're paying interest on. So yeah, like I said, compounding interest, great for investments, not great for your mortgage. And that's your traditional way of banking. That's what the big banks have done. They love it. They make a lot of money off you. That's not the way that we do things. And like I said, for the great clients, you're going to save a ton.
Thank you, Blair. Very good presentation.
Thanks for the questions.
Any other question? Yes, go ahead.
Hey Blair. My name is Artur. I have a question as well. You were mentioning a rate of 7.2. Does that indicate that mortgage is only available as a variable rate, or do you also offer a fixed rate 5-year term?
Yeah. So the main line of credit, that's the revolving main piece, that is variable. That is prime plus a half, prime 6.7% today, hopefully coming down. So prime plus a half is 7.2% today. You can lock in up to 5 fixed rate sub accounts that operate the same as a traditional mortgage. So the interest rates on those accounts, we can get you 4.79%. So you can kind of get the best of both worlds, right? You can, let's say, for example, you want to keep $100,000 of into the line of credit that offers maximum flexibility. You have access to it once you pay it down, but then you also like the structure of a fixed rate account. So then maybe you want another $50,000 into a 5-year fixed term and another $50,000 into a 3-year fixed term. Our 3-year fixed terms are really low right now too. I think at 4.99%. So you're really your own banker. You can structure this however you want. So yeah, you don't need to keep 100% of your funds into that variable account. You can set up these fixed rate sub accounts as well that operate no different than a traditional mortgage.
Wow, that's excellent. Thank you very much.
Thank you.
Hi, Blair. We have a question from one of the online attendees. The question is that what is called velocity banking?
Velocity banking?
Someone wants to know the description of Manulife One, if it's a velocity banking strategy.
Sorry, I'm not familiar with the term velocity banking, so I can't comment.
Okay, I will help you with that. So velocity banking is a strategy where you get all your money paid in one account, and then you use that money to kind of channel towards your debt. So it's the same thing. So I'm answering on your behalf. Yes, you can consider that as a velocity banking strategy. right? So you pull all your money in Manu 1 account, and then it rolls over to do what he describes to do. Any other question? Any other online question? Okay, good. So I think we have a lot of nuggets learned today. In summary, we talked about banking, daily, debt consolidation services, mortgages, credit card, having your investment, your insurance, your budgeting, variable interest versus fixed interest. If you want to transfer your mortgage, there's no cost. Manulife carries that. And those are services Horizon Growth has on their platform through Manulife. And if you're interested to learn more about this product, we can sit one-on-one and talk about that so that we divert your communication to the right people to help you with that. Thank you so much, Blair, for your time. That was an excellent presentation. We appreciate, and we will send you the contacts of those who want to meet you one-on-one. Thank you.
Great. Thanks very much for having me, Esther.
Thank you. So just on that note, do you have anything to say, Dennis? Give you 1 minute before I close to the...
You have another presenter?
They have 10 minutes. Is he ready?
Yes, he is. He's online, I think. He's there.
Okay. Okay, so we have Akshi. Is he online? Kurushi? Akshi is from Ontario. He's a new. He's going to talk about the markets over there. I know Tony spoke about diversity and them being all over the global, which is very interesting. So you can share just within the next 5 minutes what you bring from Ottawa. You are in Ottawa, I believe. Is that right?
Yes, Esther, I am in Ottawa.
Okay, so just be patient with us, please. Everyone, we have like 10 minutes, 15 minutes. We are running behind, but I believe you're learning something from this event. Thank you. Go ahead.
All right, thank you, Esther, for the introduction. My name is Akshay Kurich, and I do specialize in real estate with Royal LePage in Ottawa. There's a couple of pointers that I would like to discuss with you guys, and I think it'll be very crucial. And everything I'll be discussing, even though I'm in Ottawa and you guys are in Winnipeg, it's still the same concept. So whether you're working with a realtor over there, you can send these pointers out to them, or they can definitely help you answer the questions that you may have. So the first topic I would like to discuss is the home buying process. So Tony did an exceptional job in terms of explaining that. And some pointers I can add onto it is, number one, you want to get familiar with the mortgage broker and know what you're approved for. Because, for example, let's just say you're approved for $700,000. It helps everybody in this transaction, and helps everybody with the relationship-wise know exactly what you're approved for. So we can narrow down the funnel. So once we do that first step, that is crucial for us. And then we get to know if you guys want to buy a townhome, you want to buy a single family home, a condo, a penthouse, whatever. And then we narrow down the funnel again, which will then lead to the criteria of the property. So location is a big thing. And just remember this, the location will never change, but the home can always change. For example, I'm in Ottawa. You guys may be familiar or not familiar with the area, but I live in the Orleans area. So in Orleans, it's a beautiful, beautiful community, and it's growing quite fast. And Canada is further west. So if you wanted to buy a property in Orleans, just remember the home you're going to buy there, you can always do the same modifications and updates to the home in Canada. But the location, you cannot pick up the home and move it to Canada, right? So just remember that one thing. And then I'll explain to you guys the offer process. So Tony explained something about, never go into anything without putting a condition, which I absolutely agree. Because if you go into something without putting a condition, you're kind of putting yourself at risk. And over here in Ottawa, we are in a buyer's market. So being in a buyer's market, you have endless of, opportunities of looking at other homes that are available within the criteria. So 3 major conditions that I definitely recommend to all my clients is, number 1, financing. Because you don't want to be going into a property and buying it and you cannot afford for it, or you can't get the funds, because then it's not going to be in a situation you would want, or I would ever want any of my clients to be in. Number two is a home inspection, and home inspection is very, very crucial for the home buyer. It's because it gives you the peace of mind, right? And it tells you everything in regards to the home. So you're getting more comfortable with your own property that you're going to be buying. And whether it's a long term or you're going to be using it as an investment purpose or whatever the case may be, but it just leaves you comfortable with the property, right? And sometimes I'll get into the next point, what a home inspection can do for you actually too. And the third point is having insurability, because having insurability on the property, make sure that you have home insurance. And if you do not have home insurance, then, for example, if the home burns down, you're going to be liable for those costs. And, you know, if you get to pay that extra couple $100 per month or whatever the case may be, it's well worth that expense. And number two, the second point I would like to discuss upon is, home inspection can be very, very beneficial for the buyer. And for example, if you bought a property at $600,000 and you went into the home inspection and some things, you know, caught your eye. For example, the electrical panel needed some work in the next 5 years or so. You can then go back to the seller and renegotiate that price. So if you bought it at 600, you can say, okay, you know, the electrical panel is going to cost me about 5,000 to do. I would like it to be at 595. And just keep in mind, though, the seller is not obligated to accept it or even come to a mutual agreement. But there was a property that I just sold last week, and what happened was it was the same scenario. The electrical panel had a problem, which it was going to have to get replaced in the next couple of years or so. So what we did is we went back to the seller and renegotiated the price. And what did they do? They did come back and, you know, accept the terms that we wanted. So technically, you can get even lower than what you're initially going to pay for. So that's kind of like a bonus for the buyer. So just keep that in mind. So if you find any small thing in the home inspection, discuss with your realtor if you can kind of get a little bit of a cheaper price off the initial price, because it will save you thousands in the long run. And do you guys have any questions?
You did a great job to pinpoint what you complimented what Tony spoke about, and I believe we all understood that home inspection is very critical, and you have to discuss with your realtor, making sure that doesn't affect you in the long term. I know I got a discount on one of the properties I have because of that home inspection, right? Some water was coming from somewhere, and then the seller was like, I can take 10,000 off. So, right, so that came because of home inspection, and that's what he is pointing out. So thank you so very much. If we have any other question coming from that, I think we will connect you with that audience. In closing, I would just want to ask Dennis one question, because I've been struggling with this question with my clients lately. Yesterday, I had a conversation with one person who was approved for a mortgage, but they're wondering why they're paying mortgage insurance. And it's not the typical mortgage insurance they are paying, it's because of the amount of down payment they put, right? So they call it CMHC, Default Insurance Premium. And I wouldn't want to discuss anything about that. I'll just highlight that and let Dennis respond to that particular person who asked me in the next 2-3 minutes before you close, please. Go ahead.
So quick introduction. My name is Dennis Meritim. I'm a mortgage broker. I've worked with Maureen, but we've only sent each other emails and spoken on the phone. What we do is we get you to the money. Tony gets you to the house, and then Maureen moves the money from the lender that I get you to the seller who's selling you the house, also known as a vendor. CMHC default insurance premiums apply anytime your down payment is less than 20%. I always tell clients, if you can raise 20%, or you have 20% and you can't deploy it to anything else, just put it towards your down payment, because the default insurance premiums, in my view, is really a sunk cost, because once you pay it, it's gone. There's no way to recoup it. You can transfer it to another property through a port, but it's really gone. Now, default insurance premiums are really there to protect the lender in case of default. And if you're buying a property for about $400,000, it could go up to the tune of, let's say, $14,000. you don't pay for it right away. It gets added to your mortgage and it's amortized or spread over the 25 years that you're paying the mortgage. So default insurance premiums apply anytime your down payment is less than 20%. There's 3 default insurers in the country. There's CMHC, Sagen, and Canada Guarantee. A lot of times when we're doing deals, if you send it to CMHC, CMHC doesn't like it, we'll turn around and try these 2 other insurers. If you're buying a home with less than 20%, you don't just get approved by the lender, you also need approval by the insurer. So it's a 2-step process. A lot of times if a client is struggling to get approval with less than 20%, if they have 20%, we tell them just put the 20. We'll negotiate with the lender so that you get the approval. We could look for B lenders or local credit unions that have the appetite for the deal. The reason why default insurance was introduced was because for the longest time you couldn't buy a house in Canada with less than 20%. So the government set up this crown corporation called CMHC, approached the banks and said, okay, if you guys can lend to these guys that don't have 20%, we'll collect a premium from them to protect you. So but the truth is I've bought all my properties with less than 20% because I just didn't have the 20% at the time. And most first-time home buyers actually tend to buy homes with less than 20%. So it's very common. It's very common to pay default insurance premiums. And a lot of times the appreciation of the property will counter the premiums that you paid and you'll be fine. Before I leave, there's one thing I want to mention. There's a 30-year amortization mortgage that just got introduced. So if you're buying a home as a first-time home buyer and it's a brand new home, you can get a 30-year amortization instead of 25. What that means is it allows you to buy more home than you would have because your payments now will be less when they spread over 30 instead of 25. Thank you.
Just stay there for a second, please. I just want you to help me understand this fact. With the CMHC default insurance premiums, let's say I am sitting with a client who is planning their finances and they're looking to buying a house, right? Because you're saying it's 15,000. Actually, the client I had yesterday was 16,200, right? And they were asking me, if we can pay this, do we have to pay this insurance? And I was telling them, if you have the money sitting elsewhere, why can't you top up your down payment to 20%? Then you save this cost in the long run. But I gave them an open objection, telling them that I have to get the expertise to answer that. What would you advise if I have some extra money sitting somewhere? Because people just want to have some emergency sitting somewhere, but they can actually offset that. Would you advise them to do that?
Yeah, I think you advise them right. It doesn't make sense paying that default insurance as a lump sum. Okay. I would never recommend that. It's better if they can increase their down payment.
Okay.
I think the one thing that a lot of first-time home buyers struggle with is you've been looking at this large balance, let's say 30 grand in your account for 3-4 years, but the moment you buy a house that goes down to 0, and then sleeping at night on that night when you've moved into your house is, there's the joy of moving into your house, but now you've depleted all your savings. You'll get used to it, and hopefully you didn't buy a property that's too expensive. You can start saving again. Okay. And that goes back to Tony's point, don't buy, if we pre-approve you for 400 and your ratios are right at the max, you better not buy at 400. You should probably be looking at something cheaper. But you advise them right. They should have just increased their down payment, because the moment you increase your down payment, your premiums actually go down. Okay. Yeah, so it's a progressive, it's progressive. Like as you increase your down payment, your premium goes down.
Okay.
Yeah. Yeah. So you'll get charged premiums up to a down payment of 19.99.
Okay.
Yeah. Okay. And sometimes people will put a down payment of 19.99 because they get a lower rate. Okay. So the truth is, if your down payment is less than 20%, because you're borrowing more and it's insured, lenders will give you a lower rate than if you had a down payment of 20% or more.
Perfect. Wow.
Yeah.
That is greatly explained. Thank you so much, Dennis.
Yeah.
Okay, Sunday has a question. How long can you transfer it? Is it provincial based or not? I don't know what she means. Maybe she can expand on that.
I think the question is meant for Blair, because if you're transferring, I think the person is trying to ask if you're transferring the mortgage from one lender to another. So we can book one-on-one, or Dennis, you want to
I
answer
think
that?
this is meant for Dennis,
Oh,
because
okay.
he was speaking when
Okay,
she
okay,
sent
go ahead.
questions.
So is it about porting your insurance premiums?
Transfer something.
Yeah. Yeah. So
She said, how long can you transfer it?
yeah, so you can port your default insurance premiums between provinces, and you can also do it like as long as the mortgage is insured, right? Because you could take out the insurance out of your mortgage once you've hit a certain percentage point. Like let's say you own 20% of the house now, even though you bought it at 5% ownership. Because when you buy a house with 5% down, you only own 5% of the house. So you can definitely port. I don't know if that answers the question. And you can do it across provinces.
Okay.
Yeah. And you can do it for as long as the mortgage is insured. Because so once a mortgage gets insurance, it's insured for the life of it unless you refinance. Because once you refinance, the insurance drops. And sometimes maintaining insurability on your mortgage is great because you could do transfers. So let's say I want to move my mortgage from TD to Manulife. You could do a transfer as an insured mortgage. And the benefit of it is getting lower rates. Because the insurability of a mortgage always gives you low rates. Good?
Okay, good. Yeah.
Yeah.
So thank you so much, everyone online. We really appreciate your attendance, and we hope to meet with you one-on-one, be it looking for a home, you want mortgage approval, you are looking for a realtor, a lawyer, you want some financial education. Before you get into that, we are all here as a team to support you. I hope you got some nuggets today. You're going to learn how to manage your mortgage or get into the mortgage line with a lot of confidence. So I forgot to mention that Tony is also an author, right? So he has some books he's written about real estate. If you are interested, we have a proven system for selling homes fast for top dollar for those who are in real estate. And then we have here best-selling options in a divorce. Divorce can easily drive down your your finances. So if you have that situation happening and you want to know about that, you can contact Tony, or you can have one of his books. Now we also have one he has written here about Winnipeg, Manitoba, for sale by owner guide. So for those who are interested in real estate, be it buying a house, selling a house, getting into real estate investment, you can get this book. So thank you so much for every organizer behind the scenes. We have Camille and Alfred. Camille, thank you so much for putting the tech in place. We have Alfred here, and then we have Liz behind the scenes, and everyone who came here. We really appreciate your time. God bless you as you go do your weekend things. We hope to meet with you in the near future. Thank you, and bye for now. Oh, you guys, as you leave, you can pick information for Tony, Maureen there. We have myself information there. And if you want to know, you want some copyright things to be done on your website and stuff like that, Camille has that specialty. She can help you guys if you are trying to make your businesses and you want your faces to be out. She's there to help with that as well. So, and we have our young man here, Afrik, is a video, is social media as well. So if you are looking for help in any area of your business or your life, you can talk to them and get those services going as well. Thank you so much. And thank you, Tony, for giving us this.
No problem.
You can have some more.